Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on this afternoon's market action. Once again, looking at the three major averages, you are still looking at losses with the Dow now off 464 points. You're looking at the S&P off just over 1%, NASDAQ 100 off nearly 1%. The drop in the market coming after that disappointing retail sales number that we got out this morning, showing that sales for the month of December dropped about 1.1%. That's adding to the risk-off sentiment that we're seeing play out in the market today. Taking a look at the 10-year yield, that also under pressure here, off just about 16 basis points at 338. Taking a look at the dollar index, pushing back to the upside, but still substantially lower than where we were just a month or so ago. You're looking at the dollar index just about 102. Taking a look at the sector action today, the worst performer of the group, by far, consumer staples. Really, consumer staples off just about 2.5%. This is the group that was by far the outperformer in 2022. So some of those valuation concerns creeping back into the market here. We're seeing that reflected in consumer staples. But once again, you're looking at all 11 of the S&P sectors in the red this afternoon. Taking a look at some of the bank stocks. We heard from some of the regional banks before the bell this morning. PNC will hear from some more after the bell today. But you're looking at a bit of a mixed picture. Some of those larger banks under pressure, with JP Morgan, Bank of America off just about over 2%, looking at losses of about 1% for Wells Fargo. But Goldman Sachs clawing back some of its losses from yesterday. Huge drop in the stock yesterday. Today up just about 0.5%, Dave.
Okay, Shauna, thank you. Let's get you up to speed now on the biggest market moving story of the day. That, of course, being Microsoft confirming plans to lay off 10,000 workers as cost-cutting measures continue there. Just the latest tech giant to trim headcount in the face of looming uncertainty and higher rates. CEO Satya Nadella saying in the Davos ahead of the announcement, quote, "No one can defy gravity, and gravity here is inflation-adjusted economic growth." The cuts represent less than 5% of Microsoft's total workforce. Nadella says they'll incur a $1.2 billion charge related to severance costs, etc. The stock falling today. Instead of cheering layoffs as we usually see in this environment, it largely, obviously, Shauna, has to do with people feeling like, okay, a rough ride ahead for big tech. We'll talk more to Dan Ives ahead about this.
Yeah, Dan Ives saying that this is a rip the Band-Aid off moment. We'll hear from him in just a little bit. But Bernstein, when you're talking about the lack of reaction there in the stock, why we're still in the red, off just over 1%, Bernstein saying that given Microsoft's strong margins, the impact of cuts is not likely to really be a huge driver of margin improvement, which is probably why we're not seeing more of a positive reaction in the market today. We'll hear from Microsoft earnings next week. They're expected to report their slowest revenue growth in about 6 years. That really puts it in perspective, the rough ride that technology sector could be in for in the coming months. And remember, like you were saying, these are companies that scaled very quickly during the pandemic. Their headcount grew substantially over the past couple of years. So Microsoft being the latest company within the sector to be forced to cut their headcount.
Yeah, headcount grew 22% in 1 year. All right, let's get you up to speed now on the Fed. The Beige Book released just an hour ago. Yahoo Finance's Jen Schomburger here with the details. Jen, what are we learning?
Good afternoon, Dave. Inflation showing signs of slowing down, according to the Federal Reserve's Beige Book, though prices still increased at a, quote, moderate pace over the period of December and early January. Anecdotal evidence across the Federal Reserve's 12 bank districts showed that retailers had a harder time passing on cost increases to consumers who've become more sensitive to prices. That left some retailers to resort to discounts to move merchandise. Meanwhile, manufacturers in many districts reported continued easing in freight costs and prices for commodities, including steel and lumber, though some said that input costs did remain elevated. Looking ahead, contacts expect prices to slow further. Now, when it comes to the job market, the Beige Book showed companies are continuing to have a hard time filling open positions, even with an increase of available workers. And interestingly, many firms hesitated to lay off employees, even though they saw a slowdown in demand for their goods and services, though they said they would plan to reduce headcount if attrition, if it was needed at some point in the future. Overall, economic activity mostly unchanged with the exception of the New York region, which saw economic growth contract led by a plunge in the manufacturing sector there. Now, officials will use this information at their policy meeting in about 2 weeks to help determine how big of a rate increase they will do, whether it's a 25 basis point hike versus a 50 basis point hike. Separately, Fed Chair Powell has tested positive for COVID-19. He is said to be experiencing mild symptoms, is up to date on his COVID vaccines and booster shots, and is working from home. Back to you.
All right, Jen, thanks so much for that update. Let's talk about all this, what it means for the Fed, what it means for the market going forward. We want to bring in Jordan Jackson, JP Morgan Asset Management Global Market Strategist. Jordan, it's great to see you. So looking at losses today, the Dow off nearly 500 points. We got some weak econ data, retail sales coming in lower than expected, some hawkish comments from Fed officials today. How are you looking at the drop at today and what this means for the markets going forward?
Sure. I think the markets are trying to figure out just how weak growth is going to be or how much growth is going to slow down in the economy over the course of this year. And so obviously we're seeing some cracks amongst the consumer, given the retail sales number. Now, I know this is not adjusted for inflation. So we did see a 9.5% drop in energy prices last month, core goods prices coming down. So I think that all sort of filters into some of the retail sales numbers. We also have to recognize that it is very goods oriented, the retail sales figures. And so we continue to see signs that consumers continue to shift towards paying for services versus buying goods. But on balance, as we look at some of the manufacturing data, some of the ISM numbers, all continue to signal that the economy is certainly slowing. Now, the question is going to be, are we headed for a soft landing or are we headed for a hard landing? And so I think, again, markets are trying to figure just what kind of landing the economy may be headed for.
On that regard, Jordan, what's your expectation? Can we avoid a recession?
Well, I think we can. The reality is the labor market continues to some extent be firing on all cylinders. I will say, though, it does seem like we're seeing a bit of a divergence amongst small and medium-sized businesses and some of their larger counterparts. I travel across the country and speaking with business owners, they can't hire workers fast enough. They're really struggling to find qualified labor, and that could very well keep the wage growth number somewhat elevated. I mean, we still expect a bit of cooling in wage inflation, but still a little bit high. And certainly we're seeing layoffs amongst the larger companies that probably did a little bit of overhiring coming out of the pandemic. And so, I think we're in an environment which if inflation continues to come down, wage growth continues to remain fairly firm, we could actually see real wage growth turn positive by the middle of this year, providing a bit of support for consumption growth over the course of 2023.
Yeah, you mentioned the layoffs, in particular, really isolated on the tech sector for the most part, besides Goldman Sachs, 3,000 plus. When or if do you think they spread well beyond the big tech?
Well, I always try to remind our investors, right? Technology as a sector really only counts for about 2% of the overall labor force. So I do recognize that these are large companies that are taking up a lot of headlines, but we just aren't seeing that sort of widening out or of labor market weakness. And so again, we look at small and medium-sized business, they're still clamoring for workers, qualified workers. There's still an excess demand for labor out there, some 10 million job openings to 6 million unemployed. And so, it's difficult to say. We're just not seeing signs. Initial unemployment claims also continue to run at very, very low levels. And so we're just not seeing any clear signs that this labor market weakness is broadening it out outside of the tech sector.
Jordan, investors are putting a lot of emphasis, placing a lot of focus on the earnings results that we have gotten and what we're going to get over the coming weeks. We've only gotten just over 30 of the S&P 500 companies have reported so far, but there's a lot of doom and gloom projections heading into this quarterly results. What do you make of the reports that we have gotten so far?
Sure. So on a year-over-year basis in the fourth quarter, we're now tracking a roughly 7% decline in earnings per share growth. However, quarter over quarter, so from 3Q over 4Q, are expecting modestly positive results. And I think the year over year numbers are more so reflective of a lot of the pressures that we've continued to talk about over the course of 2022, higher input costs, higher wage pressures. But we're seeing signs, at least over the fourth quarter, that some of those pressures may have eased a little bit. And it was talked about a little bit earlier. It's really a sector by sector case. right? We're still expecting to see energy, healthcare, industrials, particularly airlines and transport, deliver positive earnings growth. Whereas the tech sector, communication services, discretionary, look to be coming under a bit of pressure. And so, in portfolios, we're still leaning a little bit more defensive. While the defensive sectors are certainly taking it on the chin today, they tend to be a bit more stable as we think about a volatile earnings seasons relative to some of the more cyclically orientated sectors, again, like technology and energy, for an example.
Great stuff there. Jordan Jackson, appreciate it.
Thank you for having me.
Just getting started here on Yahoo Finance Live. Still coming up, we'll get an analyst take on these big Microsoft layoffs, what they mean moving forward. Then our coverage of the World Economic Forum continues. Williams-Sonoma CEO tells us how businesses are faring as more consumers look to remodel their homes. And the Southwest Airlines holiday meltdown has pilots up in arms. We'll talk to the head of the Southwest Pilot Union about their calls for a strike vote. All of that in the next 2 hours. Stay with us.
Taking a look at Microsoft, the tech giant announcing plans to lay off about 10,000 workers. Shares, though, still under pressure this afternoon. The final hour trading off just over 1%. We want to bring in Dan Ives, Wedbush Managing Director, Senior Equity Analyst. Dan, it's great to see you here. So taking a look at the market's reaction, doesn't look like the street is as excited as maybe we were anticipating it to be following these large layoffs. What did you make of the news?
Look, I think it was a rip the Band-Aid off moment for Nadella and Microsoft. And we're seeing it across tech. These companies were spending like 1980s rock stars at a pace that was unsustainable. You're starting to see demand soft. And I view it as a proactive, smart move that we're going to see across tech. So ultimately, I think as we go into earnings, this is going to be a positive that really preserves margins.
How does it change your view, if at all, Dan, of the stock? And do you think there are more layoffs to come from Nadella?
Yeah, there could be some more layoffs, but really they're going to double down on cloud. They're going to be aggressive on innovation. We've seen with in terms of open AI and some other technology partnerships. And this is a company that's going to be in the left lane. They're not going to be in the right lane going 45 miles an hour. Nadella is going to be aggressive and spend, and I think hire in areas where strategically that's where Microsoft's going to be, for the coming years. But non-strategic, that's where they're cut costs. And I think it's a smart poker move for Nadella to do this sooner rather than later.
Dan, what does that normalized growth look like? Because Nadella said that he expects, quote, some amount of normalization in demand following that massive surge that we got during the pandemic. So as we look out to the rest of 2023 into 2024, 2025, what do those growth numbers more realistically look like?
I mean, when you take a step back from Microsoft, we're still less than 50% penetrated on the cloud. So I think we're just starting to go into, I'll say, fourth, fifth inning of cloud. I mean, this could be overall from Azure growth, 30%, call it line in the sand. I think bears would say that it's going to be low to mid 20s. And I think that's really the sort of setup going into earnings. And then you take this in a 2.5%, 3% IT spending environment, still significant growth that you're going to see from Microsoft, from Jazzy and AWS, from GCP and others. And I think that's what's important here is that cloud is going to be a pillar of strength despite the dark economic storm that we're seeing.
Dan, I'm an admitted ChatGPT fanboy. How significant is that in terms of the investor story? Does it play into the cloud?
Oh, yeah. I think right now, Microsoft's the best AI play out there. I mean, even when you look at some of their strategy from Git to you look at ChatGPT, I think that is just a massively smart investment here because Microsoft, they're looking at this as what they could really put around their Redmond ecosystem, from Azure, from Office 365 to the consumer point. That's why the strong are going to get stronger during this downturn. And Microsoft learned mid-90s Gates during the antitrust battles basically stopped investing in terms of social, mobile, and others. Nadella is not going to make the same mistake, which is why I view Microsoft as a winner here, despite many yelling fire in a crowded theater.
Dan, what about M&A? We have to talk about the deal to buy Activision. We know FTC trying to block that deal. Are you still confident that that deal does get through?
Yeah, I mean, that's obviously Game of Thrones battle versus FTC, but I believe Microsoft does ultimately become victorious there in terms of that's why they're not, sort of backing down in terms of going after Activision. That's a key asset. And I believe that there's going to be more M&A from Microsoft and from others in big tech. And this is something that everyone in big tech's watching because, Microsoft wins this deal. I think that really starts to, open the spigot in terms of potential M&A across tech.
Meanwhile, the next 2 quarters, how do you characterize the road ahead for big tech?
Look, I think most investors from a whisper expectation, they're expecting 8 to 10% cuts relative to guidance. So I think whisper numbers are already there in terms of, what's going to happen with guidance where you'll have a pretty significant slowdown that you'll factor in. But I think Street's looking past. They're looking past the next quarter or two. What does second half look like? What does 2024 look like? And that's why I think investors have learned from 2002, from 2009. I think today, despite obviously all the negative headlines, this really is going to create what's the next growth cycle. But I believe cloud, cybersecurity, and some of the big tech holds up better than expected. We believe tech stocks are up 20% this year. And I think FANG and big cap tech could be up more than that.
More than 20%. All right, we will see what the next 11 and a half months hold. Dan Ives of Wedbush, thanks so much.
Thank you.
Well, coming up, Williams-Sonoma CEO Laura Alber shares her outlook on home improvement industry and where she sees first-time buyers looking to remodel. We'll bring you that interview, the latest from Davos, when we come back. Mortgage application demand jumping as mortgage rates drop. Application volume climbing 28% from the prior week. That's according to Mortgage Bankers Association Index. Meanwhile, refinance demand was up 34% last week, but that's still still 80% below where it was just about a year ago. Tomorrow, we will get updated mortgage rate data from Fannie and Freddie. But last week, we did see the 30-year fixed mortgage rates fall to 6.33%, Dave.
It is remarkable to see rates continue to fall, and it doesn't, Shauna, look like they're going to go back up above 7, which is where we were when we peaked. Now, are we going anywhere near the 3.5 we were a year ago? No, but it is surprising to see people get off the sidelines at this number. Most of them are still locked in a sub-2, mid-3 mortgage rate, so it's surprising to see that thaw this market at all. I would not get too consumed by one weekly number like this. I still think what we're looking at is prices a single-digit drop this year. None of that panicky 20% peak to trough fall that some have predicted.
Yeah, exactly. And I think that also begs the question of what it's going to take to get some of those home buyers who are on the sidelines off the sidelines. Because when we even take a look, or some of the sellers off the sidelines as well, because taking a look at some of these inventory numbers, this is according to Redfin data. Now, active listings is about 21% higher than what it was about a year ago, but that's mostly because homes are now sitting on the market for longer. We haven't necessarily seen more homes come on the market. New home listings are actually off 22% year over year. So it's going to be interesting to see what it takes in order to really bring back some of the momentum in housing. But I think it's safe to say it's going to be months away from where we are today.
Well, we do have a number that could help in that capacity. For the first time in a year, home builder sentiment actually picked up. Yes, first time in a year. January saw an unexpected gain in single family sentiment, rising, albeit slightly, 4 points to 35. That's according to the National Association of Home Builders and Wells Fargo. Still, anything below 50 is considered negative, so we are still in that territory. The sentiment was more than double a year ago, registering 83 last January. So we're a long way from out of the woods. One last note on the housing sector. Surprising to see some stocks. Redfin up 33%, Compass up nearly 60% year to date. We'll get more on the builder sentiment and the wider housing market tomorrow with the National Association of Home Builders CEO Jerry Howard. It'll be great to hear what he has to say about where we're headed. All right, over in Switzerland, our anchors Julie Hyman and Brian Sazi caught up with the Williams-Sonoma CEO Laura Alber, who described what it's like to be a part of the World Economic Forum in Davos.
I always love to come here because it makes you think bigger. I mean, you're around people who are running much larger companies and bringing great ideas, and I'm always really conscious of thinking about the next thing and ideas and inspiration and how to improve things.
So what are some of the ideas that you've been hearing about that you're really excited about on that front?
I think there's been a lot of conversation about what's happening, honestly. It's a lot of uncertainty and the debate about recession, no recession. And I was reflecting on that last night and thinking about the opportunity and the importance of thinking long term and not thinking too short term, preparing for whatever might come, but building for the future.
Laura, I can't help myself. I used to cover retail stocks as an analyst for a long time. I will pivot off what you said and ask you this. What's the next big thing in retail? What do investors in this space need to know about?
Retail is, about serving consumers and what is important to them. And I think quality never goes out of style. People want things that last. I do believe that sustainability is here to last and here to stay, I should say. And it's important that people bring to market products that meet those needs, and we see that customers really care about materials that are sustainable and no off-gassing and all those things that we talked about and we put in our reports. But I can also tell you that consumers vote with their wallets when they buy our green our certified products, particularly in our children's business.
Yeah, as a customer, I have to cop to definitely looking for those kinds of elements when I look at your products. Do you think that your consumer is more resistant if there is, or I shouldn't say if there is, probably when there is an economic downturn?
I think everybody is worried right now. I mean, I think it's affecting everybody's mindset. Here we are talking about it. So I think you've got to be that much better. You've got to inspire. I mean, great retail, when you go to great retail, it takes you away. It makes you dream. You know, we were talking earlier about what we like to cook, and, you know, nothing better than being invited to a fantastic dinner party, right?
Thank you for the chicken recipe.
Yep. We're going to make some air fryer chicken. But I think, you know, people love their homes, and that is something that in your home is your biggest asset, and it's something that is so fulfilling. You know, when you redo a room or even just hang some new wall decor up, it really affects how you feel. And we all learned that in the pandemic, became much more important to us. And we're still, you know, working from home a lot more than we used to be. And as things get expensive out there and stay expensive, it's always nice to come back home. And it's definitely the best deal that you have is at home.
During the pandemic, and remains very much a key topic here at the World Economic Forum, you had a lot of first-time home buyers, a lot of 30-somethings that bought a home for their first time, probably went to a Williams-Sonoma and redid their kitchen or their bathroom. Now, a couple of years into the pandemic, where else do you see them remodeling their homes? What are they, in terms of product, what are they gravitating towards?
You know, people started projects, and unfortunately they were difficult. You know, a lot of things were back ordered. You know, it's really hard to get people to work on your house. So there's people who are still really in process of doing these projects, whether it's a kitchen or a bath remodel. And so usually the cycle goes, you buy a home, you do some remodel, and then you buy the furnishings that go with. And the minute you take everything out of a kitchen or out of a closet or out of a room to redo it and put it back in, you realize that you might need something to be
You have
replaced.
to get fancier stuff to match the
Yes.
redone whatever it is.
Exactly.
Not that I'm speaking from experience or anything
Of course
like that.
not, right?
How closely do your sales track the housing cycle, or are they somewhat separate from it?
No, it's a good question. It's hard to know where the correlations are, and we've tried to triangulate it through the years. You know, I've been at Williams-Sonoma since 1995, believe it or not. I've been CEO since 2010. You know, we always look at everything from stock market to you know, housing, people moving, all those things. But there's also the reality of just freshening up your house, right? And that's a harder thing to quantify than some of the other more life stage pieces. We do have a big life stage business. So, you know, we've built everything from, you know, your first apartment to wedding to your first house to children. And now we're actually doing products, accessible products. And that has been a new launch that we brought this year into Potter Barn, and you wouldn't believe how successful those products are.
Laura, what is the secret to CEO longevity? You are the only CEO of Williams-Sonoma that I know, that I have covered. Pull back the curtain a little bit. What are you doing that may be able to help your fellow leaders?
I really care. You know, I really care about the product and the people, and thinking about, you know, making it better every year. You know, what's next? How do you make it more efficient? How do you motivate teams? How do you bring greater products to consumers? And how do you make it easier to decorate your home? How do you demystify what is very daunting and expensive for a lot of people?
All right, Julian Saz, great interview there. Coming up in the next hour, we'll talk more about Williams-Sonoma, which shares have been on fire thus far this year. But first, shares of Chegg taking a beating on the recent rise of ChatGPT. We'll bring you that story next.
Time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We have PNC, Volta, and Chegg. Let's kick it off with my pick. That's PNC. Shares under pressure today, looking at a drop of just about 5%. We were down more in earlier trading, looking at the largest intraday drop that we had seen in about 2.5 years. Now the move lower coming after the company missed on earnings. Also set aside more than expected for future loan losses. PNC's 2023 sales guidance also falling short. The bank seeing revenue growth of 6 to 8% for the fiscal year, missing the street's estimate by wide margin. They were looking for 11% growth. It is one of the worst performers in the S&P today, and Praz, really speaks to the fact that some of these banks remain under pressure when we talk about the fact that the macroeconomic environment here continues to slow, a looming recession, what that would mean for banks, and obviously more loan loss reserves, clearly a red flag here for investors.
Yeah, you know, rising rate environment, I think that's a good time for banks usually, but I guess, like you said, those macro headwinds still pretty strong. Usually those regionals do really well during an economic upswing or before you see that happen, but not so much right now. I guess being pressured, investment banking, mortgage business getting pressured. So yeah, not looking good for PNC this time. Speaking of upswings, I'm watching shares of Volta, the charging and media company, getting bought out by Shell USA in an all-cash deal worth $169 million. Seems like a good move for all parties. Maybe we'll see Volta's chargers at Shell stations soon. You know, we had the Volta exec on recently to talk about its deal with Kroger, America's largest supermarket chain there. You know, talk about good location, right, for EV chargers.
It's a real big question that we don't talk often enough about. What does the future look like for gas stations? Shell alone has almost 100,000 in 80 countries. They have plans to have 500,000 EV chargers around the world by 2030. Can they charge for charging a car? That's going to be a huge question for people like Shell and others. 80% of the charging, McKinsey estimates, will be done at home. What do you figure there? That they'll be able to charge the consumer for charging a car at a gas station in the future?
I mean, that's in an ideal world. Yeah, that would be the solution, the silver bullet, right? But the problem is that these chargers cost so much money, and most people charge at home.
Right.
So it doesn't make sense. Like the Philips people were talking about how that was too much money to build these chargers at their locations. So there might be like hybrid use, right? The grocery store, Starbucks. Like we said, maybe a Shell station is another alternate, but you got to need like 15, 20 minutes to hang out to get some, fast charge in there. So I think that's the issue, and we'll see. Shell might be able to figure it out. But
yeah, and what's the revenue model?
Yeah, I was going to say, it all comes down to time and how much time people are willing to stay there and really charge their cars. Because I get a little annoyed after 3, 4, 5 minutes at the gas station. We're talking about a lot more time when it comes to charging your electric car.
It is a huge question considering how many gas stations dot this country. My play is education technology company Chegg, CHGG, a trending ticker on Yahoo Finance today. Shares under pressure today given the recent rise of OpenAI's ChatGPT. BMO Capital analyst Jeffrey Silber says GPT could present some headwinds to subscriber growth in the current semester, adding the traffic has declined and looks to be worsening since the launch of ChatGPT. He is, however, keeping his market perform rating and $30 price target. Meanwhile, Needham analyst Ryan McDonald also downgrading Chegg to hold from buy, seeing, quote, limited opportunity for acceleration given the slowing growth in domestic subs. Shares off about a quarter over the last 12 months and falling another, as you can see, big time, 16% on this news, Shauna.
Yeah, it will be interesting to see whether or not we do see a drop in some of those renewal rates when it comes to Chegg because of ChatGPT. But I don't think you can argue with the fact that ChatGPT is something you need to keep your eye on. We were just talking to Dan Ives earlier in the show. He was calling a potential game changer when it comes to AI, seeing Microsoft is going to be at a significant advantage compared to some of its peers because of their investment in OpenAI and ChatGPT's potential here in the future. So Chegg obviously could really bear the brunt and really be at a disadvantage if, in fact, this does take off. I don't know, though.
Have you used it yet?
I have here and there. Did you guys see that GPT just got passed its medical licensing? So it's a 3-part test that it can actually diagnose some illnesses. So
it's coming for all of us, man.
Chegg, me, you, doctors. I mean, who's next, right?
They need a better acronym. They need to shorten the name of it. By the way, Yahoo Finance had a poll. Would you use an AR platform like GPT for writing content? 60% said yes.
I'm actually surprised it wasn't higher than that. You know,
Well,
I don't know. All right, well, lots of questions that need to be answered when it comes to ChatGPT and what that would look like in the coming years. All right, well, coming up, a tough day for crypto, now in the red. But if you're looking to invest in this sector, ETFs may be the way to go. We've got our next guest here to explain when we come back.
another one bites the dust. Crypto firm Genesis preparing to file for bankruptcy. The news comes 2 weeks after Genesis laid off about 30% of its staff. Yahoo Finance's David Hollerith has the details. Yet another one, David.
Yeah, since pausing withdrawals November 16th, Genesis Global Capital has sought funding, and it's more than 300,040 creditors have organized, and they're in at least three major creditor groups, but bankruptcy hasn't happened yet, and many are actually confused as to why. It's been more than 2 months since Genesis paused withdrawals. A document shared with us today shows that creditors and the other side of the equation, Genesis and DCG, have been in talks for the last week. Over the weekend, Genesis, who's sort of serving as the middle ground in this case, delivered a proposal that both sides are currently drafting a term sheet based on that proposal. Now, for creditors, this isn't just about getting as much money from Genesis as possible. There's likely a shortfall. So the remaining assets come down to how much money they can attain from DCG. DCG has millions of dollars in loans it owes to Genesis. So what is being talked about currently, according to the document, is obviously a liquidation of Genesis's current assets, but there also may be a forbearance period set for certain payments of up to 2 years. In exchange, there would also be some cash payments on the front end and possibly equity in DCG. Again, this is Genesis's parent company who owes Genesis money.
All right, David, we also want to talk about Coinbase. Shares off just over 6% today. The big headline, though, the company's stopping its operations in Japan. What do you think is behind that decision?
Yeah, so last week they announced 20% layoff, 950 people, about 20% layoff of Coinbase's staff. So this looks like a continuation of that. From what we understand and what the company's laid out, they're trying to reduce their operating expenses between Q4 and Q1 of 2023 by about 25%. So what we're expecting from this situation is that, the Japan operation is part of that. Again, the company didn't say that they are closing the business yet, although that's obviously speculated and talked about from such an announcement.
All right, David Holler, thanks so much for bringing us those headlines. We want to stick with crypto because this sector has been under a tremendous amount of pressure, of course, stemming from the fallout from FTX's collapse back in November. Our next guest, though, saying that crypto-linked ETFs are performing extremely well so far this year. We want to bring in Cynthia Murphy, ETF think tank director of research, joining us now as part of our ETF report brought to you by Invesco QQQ. Cynthia, it's great to see you here. So certainly a number of worrisome headlines, to say the least, when it comes to crypto, yet we are seeing interest in it in crypto ETFs. Why do you think that is, and how much interest are we seeing?
Hi, Shauna. Yeah, it's been actually a really surprisingly strong year so far. I mean, we're only 2 weeks into the year, but crypto ETFs and blockchain ETFs have been like among the best performing ETFs so far this year. So to give you an idea, if you look at some of the Bitcoin futures ETFs like BITO, for example, it's up 25-26% so far this year, which is a huge performance if you look at relative to everything else in the market. In the blockchain space, you're seeing funds that are up anywhere between 25 to 50%, which is, again, a huge jump that nobody really saw coming. And so crypto went from being like really under pressure, really oversold, to all of a sudden we're seeing a pickup in performance, which of course today, every day matters. And today the market started strong and the segment has really turned down this afternoon already. So it's a volatile space to be in. But the performance has been there, and we're starting to see assets trickle into this space again after a long time of everybody shunning it.
Yeah, I do want to circle back to the ETFs, but just looking at the numbers is staggering, really. I mean, we've got Ether up 30% in the last month and Bitcoin price up about 25%. That despite bankruptcy after bankruptcy, headlines like our crew in Davos talking to Nouriel Roubini, who said 90% of crypto is a scam. What do you make of the rise of Ether and Bitcoin despite all the headline shock?
It's funny because, the it's a scam line has been around from the get-go. So it's not new. And I think what's interesting about this space, unlike a lot of other parts of the market, is that the assets are really sticky. So if you look at the ETFs in this space, despite last year's performance, where you had some of these funds down 50-60%, assets were still there. The outflows overall from the segment, both in the Bitcoin futures as well as in the blockchain ETFs, is almost non-existent. So it is a segment that the investors who bought in, they really bought in for the long run. And they're standing in there, and maybe some are dollar cost averaging and some are really betting on this long term. So it's a segment where conviction really rules, and those who are out, but those who are in prove that they will stay even when the market is really under pressure.
So Cynthia, given that, the fact that investors are committed to these funds, you're saying that these assets are very sticky. Do you think we'll see more ETFs come online that are tied to crypto in the future?
It will probably depend on the market environment. I mean, there's no point in launching an ETF in a market environment that is not really conducive to it. So, for example, if growth continues to be under pressure, launch a growth-related ETF, which blockchain really is, it's tough. You're not going to find assets right away. There's a lot of competition in the space already. So I think until the market really gets conducive for this kind of strategy and you really expand that appetite, we could see more funds come, more innovation come in the space. But right now you have about a dozen blockchain ETFs. You have about 8 or 10 Bitcoin futures ETFs. So there's a lot of offer there. Until the market picks up, I think we're probably good.
You also feel there might be some opportunity in small cap ETFs. Why so as we move ahead? And do you have a few names for us?
Yeah, so when I was here, I think last time we talked, it was about a month ago, and we mentioned the surprising bid in small cap, specifically small cap value, which is interesting if you think that small caps tend to trail and do poorly in a recession relative to large caps. So a month in from that time we last talked, we're still seeing some of that bid in small cap and small cap value. So it could be part of, even explained by this also appetite for Bitcoin and Ether and blockchain, just that kind of risk on bid that maybe a recession won't be as bad. And if it's not, small caps will outperform because they tend to recover more quickly on an economic growth situation. So it could be that, those folks who are betting that this recession either is not coming or is not going to be as bad as a lot of people are saying, they continue to bet on the segments that are going to be leading that recovery, and small caps will be part of that story. So it remains to be seen if that's going to materialize or not, but it's been definitely interesting to watch.
Indeed it has. Any sense of optimism, we will take it. Cynthia Murphy, thank you so much. Coming up, Tesla stock falling as Elon Musk faces off with lawyers over his funding secured tweet from back in 2018. We have the latest from the trial when we return.
Elon Musk's lawyers are defending the Tesla chief in a shareholder class action trial in California. Opening statements started today, and shareholders say that Elon Musk illegally cheated them out of billions of dollars with a 2018 tweet where Musk floated the idea of taking the company Tesla private. Yahoo Finance's Alexis Keenan has the latest for us. Hey, Alexis.
Hi, Shauna. Yes, so opening statements started today. They've already concluded. We're on to our first witness. These shareholders, these Tesla shareholders, they claim billions of dollars in damages. They say it resulted from that 2018 tweet from Musk saying that funding had been secured to take Tesla private at $420 a share. Now, specifically, this class of plaintiffs, they are Tesla shareholders who bought or sold during a 10-day period, beginning on the day of that tweet in August 7th of 2018, going to the 17th. The shareholders say that the tweets caused the stock price, you can see it there, to jump initially, but then they said within days it dropped from $25 to about $20 a share when the deal was off the table. Now, in these opening statements, we're getting to hear for the first time some of the details of Musk's defense. His attorney really dissected these tweets and focused on a same-day blog post from Tesla that said a final decision on taking the company private had not been made. Now, he said Musk's choice of words in the tweet, they may have been reckless, but it was a split-second decision, he said, to protect investors, when on August 7th, that same day of the tweet, there was a news leak that exposed that the Kingdom of Saudi Arabia was a major shareholder, all after Musk was in talks with the fund and had made an informal, they said, bid to his board. Now, the attorney also said that when Musk made the tweet, he knew that he could not withhold information from shareholders, that you could not give selective information to different shareholders. And so he made this decision to send out this tweet in a matter of time. Now, the lawyer also said that Musk had already been in these multiple meetings with the Saudi fund, and that shows that he was in fact considering taking Tesla private. Said he was honest about that part of the tweet for sure. Also, there was some key evidence that he said we should expect to come in this trial, saying that everyone in those meetings with the Saudi fund executives will back up that they had in fact committed to funding. Now, first up is the shareholder class representative Greg Littleton. He's on the stand. The last I dipped out of the trial, he's a 71-year-old from Kansas City, Missouri, and a former commodities trader.
All right, Alexis Keenan, thanks so much for that. And we know you are going to stick on this story for us. Well, coming up, we are counting down to the closing bell on Wall Street. All three of the major averages in the red. You're looking at the Dow off nearly 2%. We'll be right back.
All right, we're just a few minutes away from the closing bell. Let's bring in Yahoo Finance's Jared Blickery to break down the market action. What are you seeing, brother?
Yeah, we kind of got a new trend this year where the Dow is now no longer outperforming the NASDAQ. We got the NASDAQ is the outperformer here, though you'll see everything is down. Dow down almost 2%. And let's take a look at what's happening inside the market. This is a sector action for today, and the mega caps really are the least dirty shirts in the laundry basket. Everything there off more than 1%, XLC, XLY, XLK. But then at the bottom side, XLP, that's staples and utilities, that's bringing in the rear. Also, financials a little bit weak with all the earnings out. PNC weighing on the market, down about, what was it, 5% or so? But I'm here to talk about chip stocks first. First of all, semiconductors have roared to life this year. You wouldn't know it from this, but doing much better than the software sector. These, of course, are very cyclical. And let's take a look at that year-to-date performance here. You can see Taiwan Semi, ASML, each up 20%. NVIDIA right there on its heels with 19%. And then contrast the colors. The colors only with what we're seeing in the software space. So just wanted to point that out. Now, I got to move on to Moderna and the pharmaceutical space. Let me just pull up what we're seeing today. And Moderna is up 3%. You can see in a sea of red, it is an outperformer today. And that is because it delivered results for a late-stage trial of RSV. This is a new vaccine which is used to prevent lung disease in the elderly. Now, if the FDA eventually grants approval, it would be the company's second vaccine after its COVID vaccine with which it was first to market. All right, and also going to take a look at Yeti because this is another stock on my radar today. I was at the IPO a number of years ago down at the New York Stock Exchange, got some nice swag, thank you. And that stock, let's just take a look at the performance here. We can see it's down 7%. Cowen just downgraded the stock to market perform from outperform, and this is because of a slowdown in visitor traffic to its website, and that's where it sells those colorful coolers and branded drinkware. Now, Cowen is saying that similar web unique visitor traffic over the December month, that was down 3%, but the analyst likes the direct-to-consumer channel, which remains a key driver of sales and margin. Cowen has a price target of $47 on the stock. And let's take a look at another heat map as we head into the closing bell, which is right now on Wall Street.
All right, that marks the end of the trading day. All three of the major averages closing in the red. The Dow off 614 points, right around the lows of the session. Look at the S&P off just about 1.5%. The NASDAQ off just over 1% as well. We're taking a look at some of the biggest movers of the day. We first want to take a look at the worst performing sector, and that was consumer staples. Taking a look at that drop, retail sales data coming in for December, worse than expected. You're looking at XLP consumer staples sector off nearly 3% today. Kraft Heinz is a top trending ticker on Yahoo Finance, one of the worst performers in that segment today, finishing off just over 6%. And Dave, the theory here is that drop that we're seeing in December sales, what that means for consumer spending going forward. We know so many of these consumer staple names were able to pass along higher costs to the consumer over the course of 2022, when we certainly did see a resilient consumer. So as a recession looms, potentially the fact that the econ landscape is getting worse, they might not be able to pass along that higher price. And that could mean we could see a bit of a pullback here in some of those names that performed okay in 2022.
Yeah, really outperformed just about everything on the market, did Kraft Heinz. And at first glance, I thought this cannot possibly be true. Maybe Kraft Heinz is isolated. Then you go down the list of fellow Conagra, Hormel, Campbell's Soup, McDonald's, and Coca-Cola, and General Mills. All took a beating today. So clearly, this does emerge as a theme, but it really makes no sense to me, Sean. I feel like, again, Tom Hanks and Big, my favorite GIF, I don't get it, because even in a recessionary environment, you still got to go to the grocery store. And those companies like Coca-Cola that were able to pass on higher costs throughout 22, I just don't see that dynamic changing. You're still going to go to McDonald's. You're still going to get your Campbell's Soup, your mac and cheese, your ketchup, your Oscar Mayer. All these companies are not things you're going to trade down. I'm really having a hard time buying this continuing throughout the year as a theme, although we're clearly seeing it today. We did see, by the way, in the In the Beige Book, retailers said they had increased difficulty in passing through costs. So that goes back to your narrative. The only explanation is they're going to have to trim their margins somewhat.
Yeah, exactly. And what that pressure will look like on margins in the coming quarters. And then, of course, given the valuations today, I think that's some of the reason why we're seeing such a big drop in some of those stocks this afternoon.
Microsoft shares finishing the day lower after the company announced it would be laying off about 5% of its workforce. And you can see shares down about 2%. Generally speaking, when we have the narrative of trimming headcount and cost cutting, you'll see investors cheer that news. Not the case, of course, because this is more of a macro look at what's ahead for big tech, and it could be a rough at least quarter or two, although Dan Ives just a short time ago from Wedbush told us he sees a great environment by year end for big tech, including most FANG stocks, the potential for a 10% increase. But in the short term, very difficult environment for companies like Microsoft, and it won't be surprising if we're going to see another round of layoffs. But layoffs really haven't extended beyond big tech. It seems like we're going to be isolated there for the short time.
Yeah, they haven't yet. And to quote Dan Ives, he was saying that some of these tech giants, they were spending like 1980s rock stars to keep pace with that eye-popping demand. So no surprise here that we are seeing a pullback in some of that spending, and the fact that these tech giants have to correct their headcount after going on a massive hiring spree over the last 2.5 years. I think the stock reaction, though, was something to note. The fact that the stock was still closed the day off just about 1%, but of course the move lower as we did see with the broader market. The question going forward, what these earnings reports are going to look like over the coming weeks. We'll hear from Microsoft next week. Revenue there is expected to be the slowest revenue growth that we have seen in 6 years. But like you said, many on the street remain positive on the sector, remain bullish on Microsoft. Dan Ives has an outperform rating, despite the fact that he's saying we're up against a Category 5 near-term economic storm, a price target of $290, saying that Microsoft is spending in the right space. One of the big bullish points that he made was he likes the move that they had, the partnership that they have with ChatGPT, and thinks that that makes a heck of a lot of sense.
Really enhances their cloud play. He was very colorful in the jacket and very colorful in the narratives as well today. Just another one of those companies that ramped up hiring way too high during the pandemic, up 22% in 1 year and up 75,000 from 2019 levels. Just got to trim back to normal.
All right, let's take a look at Party City, because shares halted today after the company filed for Chapter 11 bankruptcy prior to the opening bell. But the party, it isn't over just yet. Hopefully, the specialty retailer planning to keep operating over 800 stores in its online store as part of its turnaround strategy. Now, this restructuring plan, it calls for bondholders to swap their holdings for equity in the reorganized company. Also calls for existing stock to be canceled. No recovery for shareholders. This, of course, has to be approved. But the listed assets, Dave, $1 billion to $10 billion, and then liabilities in the same range there, $1 billion to $10 billion, really just speaks to the position that Party City is in today.
Yeah, $150 million in financing, and you can't help but wonder if there is a plan. They're going to have to trim some of those stores from 800, maybe cut that in half. There is a massive dent in commercial real estate coming to this country, given if Party City doesn't make it through this, and Bed Bath & Beyond as well. You're looking at almost 1,500 massive real estate structures. But what really hurt them? So many factors: helium shortage, inflation, and I really think that the pop-up nature of the Halloween stores around the country took a dent out of their single biggest opportunity, which was Halloween, and they said those numbers were lower, far lower than they expected. Perhaps there's a plan to reemerge. Want to finish up with Celsius, the energy drink, finishing the day down after the drink company lost a battle in court with rapper, you know him as Flo Rida. A jury awarded Flo Rida $82 million in damages after he alleges Celsius breached an endorsement contract tied to the company's revenue that dated back to 2014. Really confused here why the stock took touch a beating, down almost 10%. As you can see, clearly $82 million in damages is nowhere near enough to dent a company that currently, and this might shock you for people that don't follow Celsius, that is an $8 billion market cap company. They have exploded in the last year. The stock up 120% last year, largely on the heels of $500 million investment from PepsiCo. But Flo Rida got his cash.
Well, Ryder did get the pay that he was looking for there. Their revenue growth has been absolutely astounding. When you take a look at some of these numbers, the first 9 months of 2022, the company said that the revenue growth was up 136% year over year. For fiscal year 2021, that growth looks like 140%. 2019 up 74%. You talk about the massive upswing that we've seen in the stock, certainly can be backed up by this revenue growth. And you got to question whether or not growth like that is going to be sustainable.
Yep. I start most of my days with the Celsius, man. It's good stuff. All right, shares of Netflix took a beating in 22, but bounced back to start this year, up almost 10%. The streaming giant releases its Q4 earnings after the bell tomorrow. Yahoo Finance's Ali Canal here with a preview. What are we expecting, my friend?
Yeah, Dave, I mean, this is going to be an important quarter for Netflix to really set the tone for 2023. If we think about this point last year, we started 2022 with 2 straight quarters of subscriber decline. So Netflix is going to want to come into this with a position of strength. And investors, they're going to want a bit of an update on some of those profitability efforts, such as the recently launched ad-supported tier, along with those crackdowns on password sharing. However, analysts have warned us that it's really the long-term game that you want to watch here. You're not going to see those efforts really reflected this quarter, a large part of that being the ad tier launched in November, right in the middle of the quarter, only 12 markets. So we're going to have to wait and really see what the executives give us on that earnings call following the announcement. But in terms of the numbers, here's what we're looking at when it comes to consensus estimates on the street. Revenue expected to come in at $7.85 billion, adjusted EPS at 58 cents a share, and then subscriber net additions at 4.5 million. Now, we do have a weakening U.S. dollar. We know the strength of the dollar has been a really big pain point for Netflix, so that weakening could potentially impact revenue as well as operating income figures. And then in terms of subscribers, we had solid record-breaking content in the fourth quarter. Wednesday, Glass Onion, Dahmer, the list goes on, and we're going to see continued content improvements planned for the current quarter. So although subscriber numbers, they're not as important to investors anymore. The focus has really been on revenue, free cash flow, and profitability. A subscriber beat would still be a win here. And as you mentioned about the stock price, I mean, 10% up on the year, 60% over the past 6 months. So far, so good. And we'll see what happens tomorrow.
Yeah, we certainly have seen a number of analysts come out in support of Netflix over the last couple of months. A lot of them very bullish on this new ad plan. So we'll see what we get from the company tomorrow. Ali, there's another big story we want to get to. Avatar: The Way of Water crossing another huge milestone here. Tell us about it.
Nearing $2 billion in global ticket sales. This is the number that James Cameron said this film would have to reach if it wanted to even get close to profitability. So you know he's championing that. But just to put this number into context, how hard this is to accomplish, only 5 films in history have ever crossed that $2 billion threshold. That was the OG Avatar, Avengers Endgame, Titanic, Star Wars: The Force Awakens, and Avengers: Infinity War. So this film has really done incredibly well at the box office, very well internationally, especially since it has not been shown in Russia, and it's outpacing projections in China. In China, by the way, Disney very happy about this, greenlighting 2 Marvel sequels with Black Panther and Ant-Man. So overall, I think Disney is very happy with its box office slate right now.
No doubt. Did you guys see it yet?
I
Way of the
haven't,
Water?
no.
Come on.
I was invited and then I couldn't go because again, it's the 4 hours. I know, guys.
You're gonna go. It's the one movie that it's worth going to the theaters
Have to
for.
see in the
I'll give you
theater.
that.
It's
Yes.
fantastic.
All right, we'll see. All right, Ali Canal, thanks so much. Coming up next, Williams-Sonoma and some of the other home goods retailers having a strong start to the new year. We'll tell you why and whether or not that's going to continue when we come back.
Retail sales declining by 1.1% in the month of December, marking the largest monthly drop in all of 2022 and perhaps flashing another sign that the consumer is slowing down spending. Here to discuss is Barclays consumer discretionary analyst Adrian Yee. Nice to see you. So let's talk about those retail sales. What do they portend for the entire retail sector as we move into 23?
That the consumer is getting less healthy. In 2022, I think what we really saw was the sub $70,000 household category, particularly in the $50,000 household income category, really pull back on spend. If you think about it, in that household segment, about 75 to 80% of their budget is spent on essentials, right? Things to just live. So not a lot of discretionary spend. What we saw during holiday is this income bracket, what we call wallet creep, kind of creeping up to 100, 125, the $150,000 household income, the top echelon of the U.S. economy. They're starting to pull back on a pretty significant basis, and they're the ones that have discretionary spending power. So it does not bode well for 2023.
Yeah, apologies for jumping in there. How much weaker then do you think this landscape could potentially get over the next several months?
So tough question. But what I will say is, let's put it into perspective. Half of the household incomes in the U.S. are 70,000 and below. And we talked about those already having pulled back on spending. The other half of them, 50%, are 70,000 and above. And they represent 65% of consumption in the U.S. So if we do see this, if we're correct and we do see this wallet creep and the indications of a sloppy holiday, right, manifesting into kind of spring, selling activity. And by the way, there are no more promotions. You're going to see the promotions dry up. And that was a huge catalyst for people to convert and to spend. So if there's pent-up demand and you see people at the higher income brackets who have the wherewithal to spend, as you just had the Microsoft layoffs, we hear about corporate level layoffs, white collar layoffs, almost on a daily basis now. And I think that negative mental impact, we saw this in the 2008 recession. It wasn't about those who could spend. They just stopped spending because you see to your left and to your right that there's, layoffs going on. And that causes kind of the mentality and the psyche of the consumer to worsen.
Yeah, one of the many things people have cut back on spending, furniture in this retail sales, and that has to do with Restoration Hardware, a stock you cover. Brian Sazi and Julie Hyman spoke to their CEO this morning in Davos. Here's what she had to say regarding the cycle between home buying and remodeling your home. Listen.
There's people who are still really in process of doing these projects, whether it's a kitchen or a bath remodel. And so usually the cycle goes, you buy a home, you do some remodel, and then you buy the furnishings that go with. And the minute you take everything out of a kitchen or out of a closet or out of a room to redo it and put it back in, you realize that you might need something to be replaced.
Said RH, I meant Williams-Sonoma. We will get to RH shortly. But that was an interesting revelation as we look at how these cycles impact one another. You downgraded Williams-Sonoma. What has surprised you as that stock continues to perform thus far this year?
Yes, it does surprise us. What I would say is we have a case in retail of what we call the rising laggards. Right. So remember, Williams-Sonoma was down about 32% last year. RH was down 50%. Williams-Sonoma is now up 9% year to date, and RH is up about 16%. There are even further laggards like Peloton and Stitch Fix that are up meaningfully more than that. So I think what we're seeing here is in the absence of information, right? And the next data point of information is going to be the 2023 guidance for these retailers in February, March, and April. And I think in the absence of that, people are trying to play this beta trade. Like, what if things are actually better? What if freight is actually net positive to the margins? The reason that we downgraded the home furnishing space is what Laura Alber was saying, and huge props to Williams-Sonoma for making it through this entire period of time with such strong margins. But the fact of the matter is, last third quarter was their first demand comp that was slightly negative. Right, their actual comp recognized revenue was up 7%. And through this entirety of the pandemic, this is their first, but for 1Q20, this is their first kind of slight break. And there is a lag period between the time that you see all these macro factors, slowing home sales, all those different macro factors that impact the home sales, there's about a 6 to 9 month lag. And so that demand comp is really what we keyed in on.
And Adrian, I know you were saying promotions you expect to start drying up. What about inventory levels? I guess more so, what does that tell us about inventory levels? Are they expected to significantly improve? And how do you expect executives to manage those inventory levels following what's happened over the last 2 years?
That's a great question. And for all of the other apparel categories, the discretionary categories, we are seeing that the third quarter was that inflection in inventory. Inventory started to grow slower. The only two retailers that we follow that did not have that phenomenon happen, their inventory spread, right, sales dollar growth relative to inventory dollar growth, were Williams-Sonoma and RH. In large part because their sales slowed, right? So sales slows immediately, and you kind of slow down your inventory over the course of 6 months. So that's really for the rest of retail. We think that they're going to be starting in a very, like apparel, they're going to start in a very clean inventory position in 2023. But it seems to be at the margin getting worse for the home furnishings guys due to sales slowing, right?
Indeed. Adrian Yee, great perspective there. Thanks so much. Appreciate that. Coming
Thanks
up,
so much.
The road ahead for Volkswagen. Our very own Proud Subramanian had the chance to speak with the Volkswagen US CEO about the company's EV growth expectations for the new year. Don't go away.
Volkswagen sales were down overall last year, but EV sales showing signs of improvement. They were up. Yahoo Finance's senior autos reporter Proud Subramanian had the chance to speak with the U.S. CEO of Volkswagen about this. And Proud, what did he have to say?
Yeah, that's right. VW, the number 2 global automaker, reported its sales dip last year, but EV sales climbing higher, up 26% year over year. One of their biggest EV sellers was the ID4 SUV. I spoke to him about this and about the sales of that EV and how it was received by customers.
The reaction from customer has been incredible, amazing. We have over 20,000 in orders, in back order for 2023. Just to give you a point of reference, Press, in the Q4 of last year, the EV industry grew by 55%, and we grew by 122%. So we more than doubled the performance of the industry in Q4. And the ID4 has been one of the main sellers within our product portfolio in Q4 last year.
So VW makes that ID for its massive Chattanooga plant here in the U.S., meaning it qualifies for IRA tax credits. However, it seems they could have sold more cars overall here and abroad if not for supply chain issues. Here's to see again on whether these things are getting any better.
I think over the last 2 years, things have improved. Are they perfect? No, they're not. We still have some of the issues, but I think the issues have been reduced versus 2022 and particularly versus 2021. So I think it's not only semiconductors, but it's this entire supply chain, whether there are different suppliers, tier 1, tier 2, some of the logistic companies, but they're easing out. I think 2023 we'll still have some issues, but there will be minor issues compared to 2022 and particularly 2021.
So it's improving, it seems, and a good thing because 2023 will be a big year for VW with the ID.7 sedan coming out later this year and the ID Buzz, that quirky EV microbus coming out in 2024.
So that primarily, I think you may have just answered this question, but the EV models in the next year or so, what's their plan ahead?
I mean, so big picture, they want to have 25 EVs out by 2030. I mean, that's a significant amount of models. I mean, they only have 9 cars, I believe, on sale in the U.S. right now. So imagine 25 from now until then 25 new EVs coming out. So kind of flood the market there with the number of these cars, sedans, SUVs, even that, like, so the microbus, that fun little microbus that we've known, VW for many years to do. So it should be interesting to see how they actually attack the U.S. I mean, this is a huge automaker, number 2 in the world, behind only Toyota. So it's funny because VW is so far, they're really pushing hard, but Toyota hasn't been really pushing that far at all right now for EVs.
25 models. They're the anti-Tesla, I guess, in that regard, huh? Product diversification. Pros, good stuff. Thank you, man. All right, Elon Musk is not among the many bold-faced names in Davos this week. Why depends upon who you ask. Elon tweeting that he declined the invitation because it was, quote, sounding boring. The forum spokesman, however, says his last invitation actually came in 2015. Elon's absence did not mean he was not discussed, however. Here's Eurasia Group President Ian Bremmer to our team this morning.
The fact is that the United States has attracted the most extraordinary entrepreneurial talent in the world. And I'm very proud to live in a country where that's true. And not all of them were born in the U.S. A lot of them were born in other places. They came to the U.S. because they understood that. That's Elon Musk. That's Jeff Bezos. That's Mark Zuckerberg. It's all these people. But the fact is that those people worth hundreds of billions of dollars also, at the same time, have literally no interest or conception in their role as stewards for civil society and American democracy.
Do they have roles as stewards for civilized society? Therein lies the larger question. Or do they have a responsibility to their shareholders to earn money, because we are all about capitalism here? And I, for a second, I got to separate, and he is brilliant, Ian Bremmer. I think you got to separate Bezos at least from Zuckerberg and from Elon Musk. Look, Zuckerberg, I think you could argue either side of the coin. Certainly what he did with Facebook, sowing disinformation regarding elections, that certainly was probably not healthy for our society. But Elon Musk as well, and now you see the rise of anti-Semitism and hate on the platform since he took over Twitter. He brings up an interesting point, but should these massively wealthy, successful tech titans be focused on a social responsibility or shareholder responsibility?
They should be focused on both, I think, in a perfect world, whether they would be able to kind of walk that line and be able to please everybody and be able to be for the better good while also driving the bottom line. I think that's a situation where many people want. But when it comes to Elon Musk, I mean, he's a tough guy to keep up with. I don't think it's any surprise he weighing in saying he had no interest in going to Davos. Davos saying that he didn't actually get an invitation. We know he's busy this week with the trial going on over his 2018 tweet about taking Tesla private. And then we also got numbers out from The Information today regarding how Twitter has done since he has taken over that business. And when you take a look at those numbers, not too impressive. Twitter seeing a revenue drop of 35% to just over $1 billion in the fourth quarter. Again, this is all according to The Information. 72 of its internal goal for the year, citing global sales and marketing chief at a staff meeting. That's where this information came from. One of the factors, though, that hurt the business apparently over the last couple of months was the Twitter Blue subscriptions, which we have talked about so much. The fact that we had seen it fell short. They weren't able to sniff out all of the fake accounts on there. Certainly had the debacle. We talked about how senators were being impersonated, how many people were being impersonated on the site. So Elon Musk has his hands full, but I did love what Ian Bremmer had to say about all of it.
A fire sale literally at Twitter HQ today in San Francisco as they auctioned off essentially everything on the walls, including kegerators and cappuccino machines. $2,000, by the way, for a kegerator.
Wow.
You're too late. The bidding is already closed.
$2,000?
I guess they're expensive, man. I mean, who has a kegerator in their office is the larger question. Quickly, I want to add a Morning Consult poll that looked at Elon Musk's favorability among U.S. adults. It's now at 13.4%. That's down a little bit from 16 last month, but down from 28% in January of 22. So in a year, it has been cut in half among U.S. adults. And what is the bottom line there? Well, that means your customers, at least when it comes to Tesla, think about a person, a personality, and politics when they're buying a car. And that you do not want.
Yeah, certainly. We've heard a number of analysts come on this show right here and talk about the brand damage that has stemmed from Elon Musk and everything that's gone on over the last several months. You're looking at market cap for Tesla of just over $400 billion today. Dramatic drop here that we've seen over the last 12 months. All right, coming up next, Southwest Airlines pilot union plans on holding a vote that could give it the power to call a potential strike. We'll talk to the leader of that union on the other side of the break.
More turbulence for Southwest Airlines. It sounds bumpy ahead. Still reeling from the disastrous holiday meltdown, the airline's pilots union now planning to hold a vote that could give it the power to call a potential strike. Here to discuss is the president of the Southwest Pilots Union, Captain Casey Murray. Nice to see you, sir. So why are you calling for this vote, and why make this announcement now when a vote couldn't happen until May?
Well, thanks for having me. And, I want to address, this is about our customers. This is about the heart of Southwest Airlines that we're fighting for here. The consumer confidence currently for Southwest Airlines is at an all-time low. We've seen meltdown after meltdown, and with Christmas being just a huge exclamation point. So really the time is now to really get Southwest to address the processes that have put them there. And that is part of our negotiations. This isn't about money, and it is more about, our customers providing confidence and reliability in when they buy a ticket on Southwest.
How would a potential strike help Southwest customers?
Well, I think that our customers in the short term need to know that there is some reliability issues, and the confidence is not high moving forward, and a strike vote definitely impacts that. But the core of our negotiations are built around what we've seen Southwest doing for many, many years, and it's connecting pilots to airplanes, and that's where we're failing. There's IT issues, there's infrastructure issues, but if at the end of the day you're using the same processes that have failed you time and again, then that has to be addressed. Unfortunately, they haven't been, and we've tried to address them in negotiations, and the company just doesn't want to go through the effort of really fixing what is fundamentally wrong with Southwest Airlines right now.
If you were a customer, would you fly Southwest right now?
Well, I wouldn't right now. I think that's clear. I think that's Southwest, and that's really a strong statement because again, this is really about the heart of Southwest Airlines. Our pilots have been whistleblowers for years over all the things that have been going wrong that have led to our unreliability and these meltdowns that continue to occur.
So in your words, that holiday meltdown, more than 16,000 flights canceled, was caused by what? We've heard about this outdated computer system. We've also heard about your problem, which was connecting the pilots to airplanes. They are not on the hub system that other airlines were. What was the heart of that meltdown?
Well, in any of our meltdowns in the past, there is an event, whether it's weather, whether it's an ATC issue, that creates sort of the domino effect that we see Southwest unable to really recover like our peers. We have a point-to-point network system. It is very complex, and it requires very complex solutions. And that's what we're trying to really talk to Southwest and force Southwest to really look at, is not the network itself, but the processes in getting our pilots to airplanes and getting our customers from A to B safely and efficiently.
The CEO of Southwest, Bob Jordan, has said the need to double down on existing plans to upgrade systems. Do you believe that process is underway?
Well, I hope. I've seen a little bit of backtracking recently on some of those statements. I also saw where he said, we're looking at investing $1 billion in technology, and technology is critical to it. But if you program this $1 billion of technology with the same processes that have continued to fail you, then you're doomed to disaster. And that's what we're trying to address. So the time is now and that's why this SAV, and it's why I like to say this is about the heart of Southwest Airlines. This airline, has to be here. We are the stakeholders. All of the employees love Southwest, and we just want to see it succeed, and we want to see our customers have confidence in the product that we're offering.
And the pilots have, quite frankly, never had more negotiating power than they do right now, given the pilot shortage. What are your demands in terms of salary increases? And we've also understand that you're calling for gratuity pay for that Christmas meltdown. If you could elaborate on that.
Well, we're not calling for it. It was something offered by the company. We have to negotiate it to put it in writing so that it's done correctly. And that's something we're not against. But as far as demands, the market is going to set economics and all. We're not worried about that. This is more about scheduling. This is about a predictability for our pilots and confidence for our customers. That's what's failing now. And so this is more about our scheduling systems, our scheduling processes that Southwest needs to address if they're going to address their reliability issues.
I just want to make sure we get a statement from Southwest regarding the vote. Quote, the Southwest Airlines Pilots Association call for an authorization vote does not affect Southwest's operation or our ability to take care of our customers. The union's potential vote does not hinder our ongoing efforts at the negotiating table. We are scheduled to resume mediation on January 24th. Head of the Southwest Union's Pilots Association, Captain Casey Murray. Appreciate you being here, sir. Thank you.
Absolutely.
Sean?
Retail sales this past holiday season growing over 5% from 2021 to more than $936 billion. But that fell short of what the NRF, the National Retail Federation, was forecasting. Joining us now to discuss the impact of inflation and the consumer, we want to bring in Yahoo Finance contributor Vera Gibbons. Vera, it's great to see you here. So retail sales, yes, we did see growth there of just about 5%, but not exactly that kind of growth, the 6 to 8% that we were initially anticipating.
Nevertheless, those are pretty healthy numbers there. I think the retailers were very nervous. Consumers weren't going to spend, given the rising interest rate environment, given the inflationary pressures, given people worried they were going to get let go. But consumers actually did go out. They spent. They responded to the early promotions and discounts back in October. They didn't want to miss out on those. They were afraid about stock out, so they jumped in feet first. They spent, and I think a lot of consumers actually just made up for lost time. They really wanted to enjoy themselves this holiday season. Big spending on experiences in particular, and of course, gift cards continue to be popular as well. Now we're getting into a different type of season, and this is the return season. And this is a challenging time for retailers because $171 billion, or about 18% of merchandise that was purchased over the holidays, is now expected to be returned to the retailers. They are, they're in a tough position because they've been lenient the past couple of years. They were nervous about consumer spending, so the free returns were definitely a thing that was attracting consumers. And now if you fast forward to today, their costs are up considerably because of the inflationary environment. They've got the shipping costs, the stock and restocking costs, getting it back on the shelf, logistics, it adds up. And, over the course of making a return, the retailer the actual item could actually lose as much as 85% of its value. And the retailers are not in a position to absorb those costs. So what we're seeing now is a lot of these retailers have changed their return policies, making them a lot stricter, really trying to crack down because they're trying to protect their margins.
What are the biggest changes in the return process this year?
Well, we are seeing shorter return windows, shorter refund windows. If you go to make a return, they may not give you anything back whatsoever, particularly if that item has been marked down several times over. And the problem is a lot of consumers are surprised. They go to make a return and then they find out, oh, wait, there's a $7.95 restocking fee or an $8.95 restocking fee. When did this actually happen? So consumers don't like the element of surprise, which is why we're seeing a lot of consumers re-gift or donate to charity. Just get rid of the gift any way they can rather than actually make that return. I think the big problem has long been what's been going on online. They have been super lenient, just print out your label, bring it back, send it back. Bracketing has been a huge problem for the online retailers where you buy a bunch of different things, you try them on, maybe you keep one and return the rest. Fraud has been a problem for them, wardrobing. So they're really trying to put an end to that. In fact, if you look at what happened last year, most retailers actually changed their return policies or are in the process of actually changing them now. They're becoming more transparent. They're putting better pictures on their website. Ultimately, they're putting the onus back on the consumer.
Sure has been more difficult this year than I ever recall making a return. Vera Gibbons, thanks so much.
Thanks.
All right, coming up, we head to Davos, Switzerland to talk to Cloudflare CEO Matthew Prince on the rise in cyber attacks and protection regarding Russia's cyber threats. Stick with us. All right, our coverage from the World Economic Forum in Davos continues now. Let's head over to Brian Sazi and Julie Hyman in Switzerland.
Thanks, Sean and Dave. We caught up with Cloudflare CEO Matthew Prince here at the World Economic Forum and asked him his top takeaway so far.
There's a lot of concern over the economy. It's coming up from almost every conversation that I have. I think people are seeing that. I think there's still a lot of concern, obviously, around the war. We are within a short train ride of the front lines in Ukraine. And so over and over again, I think that the theme of this Davos is really concern.
Where are you seeing that concern in your business, right? Because you did have late last year a cautious tone from you all as well. Now it's been, 2 months since then, more or less. What can you tell us about what you're seeing?
Well, I think we've been cautious for well more than 2 months. We actually started talking about what we were seeing as a slowdown in the economy almost a year ago, and saying that what we were seeing was customers were asking for ways that they could save money on their IT bills, that they could get more with less, but at the same time that they really had these huge cybersecurity concerns. And so at that level, it's sort of a tension in our business where people need to have the cybersecurity protection, but they're looking to us to also help them save money with some of the other vendors that they use.
And yet you raised prices, I believe, for the first time ever. So how did you sort of thread that needle then? If your customers want to save money, but you also are facing higher costs and you're raising your prices.
Yeah, we raised prices because we really wanted people to pay for our services on an annual basis, our low-end customers. And what's been amazing is that that was incredibly well received. In fact, if you go and just look at even the social media around it, people are saying Cloudflare delivers so much value, delivers so much that I'm happy to pay them more. And I think that was actually really well received. And so I'm excited that our customers are so loyal to us.
And like you mentioned, Matt, you do get a lot of credit on Wall Street for seeing that economic slowdown before a lot of others in your space. And now we're seeing a massive tech slowdown. Stock prices are under pressure. How much longer before the cycle plays out, or when do things start to improve a little bit?
No, I don't know. I don't see things turning around in the short term. We have quite a bit of visibility because so much of the internet sits behind us. Somewhere between 20 and 25% of the web sits behind Cloudflare. So we get those early indications. We can see e-commerce spend slowing down. We can see B2B spend slowing down. And that's what we saw at the end of 21 into 2022, why we slowed down hiring ourselves, and why we actually are in a pretty good position, I think, compared with some of our peers that maybe didn't have that same visibility. And so, unfortunately, I don't see that turning around, certainly in the near term, but I think that this period of time is really a period of time for companies like Cloudflare, other tech companies, to really refocus on how they can be the best companies they can be, as efficient as possible. And I'm confident we're going to come out of this a lot stronger than we went in.
It's just a question of when, I guess. I want to ask you about cybersecurity as well. You guys regularly put out reports on various kinds of cyber attacks. Where are we on that? Are things getting worse? Are things getting better? How are things evolving? What's your big takeaway on that front?
When we were here in May, I think what we talked about was a real concern that there was going to be a big uptick in cybersecurity attacks, especially coming out of Russia. The fear was that Russia would retaliate against the allies of Ukraine by using cyber as a weapon. And I think maybe the big cybersecurity story of 2022 was that didn't happen. It was actually much quieter than we expected.
And sorry, did it not happen because the defenses were good enough, or did it not happen because they're so distracted with the ground war that they're not doing it as much as you would have expected?
I think more the latter than the former, and some other really interesting things. A lot of the cyber gangs were actually made up of both Russians and Ukrainians, and they literally tore themselves apart, where an example of one called Conti, the Ukrainians actually released all their sort of secrets so that they couldn't do their hacking anymore. And so I think that's been a distraction, and unfortunately, towards the end of 2022, we started to see more attacks, those targeting Japan, those targeting Poland, Germany, the UK, looking at that infrastructure. And so I unfortunately think that while we were worried about this in May, and it's not the time to let our guards down. This is really still a shields up posture. And going into 2023, we're seeing more of those attacks. We're also seeing attacks by the North Koreans actually posing as Russians, sort of just taking advantage of the chaos that's going on and doing kind of mischief that's out there. So I think 2023 is going to be a lot of cyber attacks, and we're well prepared to make sure our clients are safe.
We talked to the Klitschko brothers about what they're dealing with on the ground in Ukraine, just very powerful stories. But they did mention and remind everyone that Russia remains a very big risk, not just to Ukraine, but around the world. I mean, do you get the sense that Russia is gearing up for some form of large cyber attack?
It's hard to know. what's going on inside of Russia. But what we're doing is making sure that, first of all, in Ukraine, we're offering our services to the Ukrainian government at no cost. We've been doing that since even before the invasion to make sure that they are hardened, that they can protect themselves. We're also helping make sure that images, messages, videos of what's going on the front lines and the atrocities that are going on can get out of Ukraine. And then thirdly, we're making sure that inside of Russia, that the people who want to avoid Russian censorship can actually do that using Cloudflare's tools to see what's going on. And we're really proud of the fact that organizations like Bellingcat use Cloudflare in order to be able to show a lot of the atrocities that are going on inside of Russia. And we're going to continue to do that and continue to support the Ukrainian people.
And I want to give you a little bit of credit before we let you go, Matt. Every year you close this event, Cloudflare, with a really great gathering of everyone here, great party atmosphere, but you're not doing that this year. And I see a lot of other folks here in tech still throwing these lavish parties. Take us behind that decision to just reel it in a little bit and be mindful of what's going on out in the world.
You know, it just didn't seem like the right year to be celebrating. And I think when we see a lot of peer companies laying people off, when we see people in the tech industry really struggling, the idea of throwing in flying in a big performer, spending a ton of money on a lavish party didn't make a bunch of sense. And so we're still getting people together. We're doing something that's much more modest, and we're hopeful that by next year the economy will be recovered and we'll be able to do a big party again. But this year, I think it's time for us all to reflect, to all take stock of what we're doing, and to really be more efficient and be more mindful of, again, a lot of people that are going through some really, really hard times.
Julia, it was really interesting what Matt said about the growing risk of Russia as a cyber threat. Didn't get a lot of attacks last year that we know of, but maybe gearing up for something big at some point this year.
Yeah, definitely interesting. But he also said how opaque it is. It's really hard to predict. So we'll see what ends up happening. Shauna and Dave, back to you.
All right, let's see what's trending after hours, Shauna. I hope, for Sazi's sake and for the economy's sake, the party is back.
I hope so, and I hope some of the parties are still underway. I've been tracking his Instagram, though. It looks like he's having a few beverages, so he's finding those parties out there, definitely. All right, let's take a look at some of these movers after hours. We have 4 stocks over here. We have Alcoa, Discover Financial, Vroom, and Apple. Kicking it off with Alcoa, we're looking at losses of just over 3.5%. Earnings from the company saying that demand is falling. They're cutting back on their shipments of aluminum here. Fourth quarter EBITDA missing the estimates by a wide margin, coming in just around $29 million. The street was looking for $106 million over the past 3 months. So still looking at pretty significant gains with the stock up just about 34%. Let's take a look at Discover Financial. We're looking at losses of just over 6% here after hours. A company setting aside more than expected in terms of for future credit losses. $833 million was set aside in its latest quarter. The estimate was for just around $360 million, so more than double than what the street had been anticipating. Also, management total net charge-off rate rose to 2.1%. The estimate there was for 1.37%. Also, 30-plus day delinquency rate for credit card loans, that's at 2.5%, and that was up from the prior quarter there. So some weakening trends, some concerning trends in terms of what they are seeing from their customers. That's a big reason why the stock off just about 6% today. For the fourth quarter, though, looking at the top and bottom line numbers, they came in better than expected. EPS of $3.77 a share over the last 3 months. We're looking at gains of just about 6%, which has been wiped out in extended trading. Over the past year, though, we're looking at losses of about 17%. Let's take a look at Vroom. That stock up just about 1% here in extended trading. The move higher on some cost-cutting measures here from the company. They're cutting their headcount once again. This time the layoffs affect about 20% of the company, but when you combine it to the layoffs that have already been announced at Vroom, they've eliminated about 50% of their workforce going back to just about a year ago. Wells Fargo cutting their price target on the stock earlier this month to just about $1, about 4 cents from where it ended the trading day today. Again, the volume, the current economic environment certainly has been tough for Vroom. Over the past year, we're looking at losses of about 87%. Taking a look at a max chart, this company went public during the pandemic in the middle of 2020. We're looking at losses of nearly 98%. And rounding it out with Apple, taking a look at that chart here, off just in extended trading at just about 0.1%, but a report from Bloomberg, that's what we want to bring your attention to. The report saying that Apple plans to expand their smart home lineup, so really going head-to-head with head-to-head with Google and with Amazon, who really has a stronghold in that category right now. They are working on on an iPad-based device that will offer smart home controls. Also reports here that the new Apple TV set-top box will be coming next year, which will include a faster processor. So again, that stock moving to the downside here after hours, off just about 0.1%. We'll be right back. Let's take one more look at the markets before we go here. A down day across the board. All three of the major averages ending in the red. You're looking at the worst day for the S&P in more than a month. The Dow closing off over 600 points and the NASDAQ off about 1.2%. So some selling here across the board. That weak data that we got out from retail sales ahead of the bell really set the tone for the rest of the day. We also got some hawkish commentary from Fed officials that added some concern here to the markets. That does it for us today on Yahoo Finance Live. Thanks so much for tuning in. We'll see you right back here again tomorrow.